How's it going? And welcome back to another episode of How to Invest in Commercial Real Estate. And this is our favorite time of the year. It is distribution time.
Distributions.
So this is the best time of year because we get to send out checks. We raise a ton of money to put these properties together, and people are investing the money because they're getting a return on that investment. Some of them are development deals where you may not see any cash flow along the way, but a lot of them are shopping centers or something we're going to hold for a long period of time. And we distribute that cash flow every single quarter. Yep. So just last quarter for Q4, we'll do last quarter and then we can do some fun stuff for last year. Just last quarter, Criterion did $250,000 worth of distributions. Super excited about that. What about you guys?
Just the last quarter?
Just last quarter.
Precision Equity is around $600,000, which is kind of our run rate lately.
That's a lot of money. So
$850,000.
$850,000 every single quarter going out to our friends and family and colleagues and business associates. And now people all over the country, thanks to the podcast and people going to the website and signing up for the investor list. But just last year, so last year was a great year. We set a ridiculous goal. We said, hey, interest rates are amazing. The market is hot. We need to strike. We need to go out and buy some real estate. So we bought $60 million worth of real estate last year. And last year we were able to distribute $5.7 million out of Criterion back to Criterion investors.
Yeah, that's nice.
So if there's not an applause playing in the video, massive applause. And that's something I think we're all super proud of. That's a lot of money.
Yeah.
And so some of that, a lot of it was cash distributions, but some of it was from sales.
Yeah. So $1 million was distributions from those assets that we're holding for the cash flow. 4.7 million of that was from 4 assets that we had sell last year. So that will be the portion of their original investment back and whatever share of profit was assigned to those sales.
So just a note on Precision, because some of the same investors, I think just in distributions, no property sales, just cash flow and profit from deals that people are invested in, 4.5 million.
That's insane.
So that's over 10 million between the two companies.
Yeah, it was crazy. And so when investors, when they sign up on our investor list and then we launch a deal and they're like, it filled up in 2 hours. Well, this is why, because not only do they have more assets to invest, but every quarter we're sending 850,000 back to them that they want to turn and give back to us. So it's this game of our investor list is growing, but so are the pockets of our investors as we give them distributions every single quarter. And in the case of this year, when we had property sales and Precision Equity hitting records, almost $10 million going back into the pockets of people that want to do more deals. We can't find the deals fast enough at the moment, especially with interest rates rising. So it's going to be a tough year, and you're going to have to act quick if you want to get in these deals.
Yeah, and I would say on that note, right? Like if you're interested in getting involved, don't wait for a deal. Don't wait for me to send you an investment asking for something. Ping one of us, call one of us and say, hey, I love what you guys are doing, or hey, you guys suck, whatever you want to start it with, but I'd like to get involved with you on an investment side. Keep me in mind on your next deal. A lot of people now, I go and pre-place commitments for because I know that guy's going to be in for 50 every single time. I know this guy's going to be in for 75, and we can adjust that on the back end. So just shoot us a note and say, hey, I'd like to get involved more. Reserve me a spot on the next deal. Yeah. And then if we need to back you down, it's fine.
Yeah, just hit us up and say, hey, I think I've got this much money I'm willing to invest, and why don't you pre-populate me next time so that I don't lose out.
And why that's so helpful for both companies is that we're going out and looking at deals. And if we had, let's say, 10 investors, 15 investors, 20 investors say, hey, I'm good for 50 on the next one. I'm good for 100 on the next one. Now it helps me go find a deal because I know I've got the backing. So let's say I'm looking at a $5 million deal, but now I can look at a $12 million deal because I know I have the capital that's able to take that deal down.
Yep.
And once again, guys, if you tell us you're in for 100 and then we pitch the deal to you and you're like, I don't like that deal. It's no commitment on that, but it does allow us to foresee how many investors want in and to what kind of capital we have access to on each given deal.
Yeah. Lets us know what size of deal we might want to be able to chase.
Yeah.
And with that in mind, that's not a bad segue into our next deal, the first deal of 2023.
Woo!
What is it, Braden?
Oh, it's on me now. Okay, I see how it is. So it's in Burleson, Burleson.
Well, it's Burleson, Burleson,
Yeah,
Texas.
we know a lot about this investment. We know how to pronounce where it's from.
We'll just say it real fast. Burleson.
Oh my, that's not going to edit well at all. Okay, we should know how to pronounce the
All right.
name of the city.
South Fort Worth.
That's easy. It's a suburb of Fort Worth, Texas.
Growing South Fort Worth suburb. So our partners on this deal, retail partners, they're based in Dallas. Our other partners, Woodmont company, we've done tons of deals with both of these companies now. Both of them are in Dallas. The guy who connected us to retail partners is Woodmont. So
they're in Fort Worth, actually.
They are in Fort Worth.
So this is in their backyard.
And retail partners is in Dallas. But anyway, it's a growing suburb of Burleson, and we're basically repeating. See, I still can't say
a suburb of the town he can't pronounce. That we're getting real small on.
Anyway, the last two deals we did with retail partners were a 3 to 5 unit multi-tenant commercial strip center that we're building from the ground up, and they were accompanied with a ground lease or a pad site or a build to suit. So this is essentially the exact same thing. We're doing a ground lease with Black Rifle Coffee Company, which is a local veteran-owned drive-through coffee concept similar to a Dutch Brothers or a Starbucks or a Scooters or something like that. And then there's a 3-unit commercial strip center going in, and those 3 units are filled with Fat Burger, which is a burger franchise. Obviously, they sell burgers. They're probably super greasy. I bet it's delicious, to be honest. You know, when you get the brown sack, and it's just
fat
like
burgers.
Fat burgers. We have a Fat Guys burgers here, but fat burgers.
Fat burgers.
They literally don't have any meat on them. They're just fat.
It's just grease. Anyway, so there's a Fat Burger, a Cool Greens, which is essentially the opposite of a Fat Burger.
Yeah. Cool Greens is what? I can't remember what they do.
You don't want a fat burger? How about a salad?
Yeah, so that's
either place.
A franchise based out of Enid, and it is really healthy, quick, fast food, and they have a to-go market as well. So salads, wraps, that sort of thing. And then there's an Athletico, which is a physical therapist. So those 3 tenants in a building, Black Rifle Coffee Company that has a ground lease. We are scheduled to buy 2 acres, I think is what it sits on,
1.89.
1.89. The land is ridiculously expensive. I mean, $3,090,000 for the land.
Wow.
Crazy. But it's in a great location. This is supposedly the spot to be, the major retail thoroughfare that runs through the city. This is right on that. Obviously, it's a good enough location for all of these tenants. These tenants are fairly picky about their locations, and our partners feel really good about it. So location seems fine. The leases are great credit. I believe they're all 10-year leases. We're going to go get a 2 to 3 year, I think it's a 3-year construction loan. The rate on this deal, obviously, rates kind of suck right now. I mean, they're insanely high. It's hard to make stuff work. We talk about that with shopping centers all the time. If we're going and buying this massive shopping center and paying 7% on the debt versus 4% on the debt, that 3% is hundreds of thousands of dollars sometimes. So that comes directly out of the investor's cash flow, right? Where on this deal, we're not going to have cash flow until the building's done anyway. And as soon as it's done, we're going to put it up for sale because we're not planning on holding the asset. So it's really just about the carrying costs of interest for that first year. And since you're holding it such a short amount of time, it works out to pay the higher interest rate.
How many months for construction on this one? You recall?
Super quick. I mean, 8 to 10.
That's what I would expect.
All right. Well, the investors want to know how much they are going to make.
Yep. What's our projected IRR on this?
Yep. Great questions. So we do a best case, kind of a middle, average of the two, and a worst case, all blended in. I think the worst case scenario is an 18.54 IRR. That's assuming an exit in the 18th month.
Is that to the investor or to?
That's to the investor.
To the investor,
yeah,
okay. Which is a 1.3 equity multiple. The best case is a 24.5% IRR, which is a 1.41 equity multiple. And then the middle, where they normally come around, is 21.63, a 1.35 equity multiple. And that's right in line with a lot of the Kiddie Academies we've done. The Dallas Kiddie Academy we just exited with a 1.33 equity multiple. The Kiddie Academy Redevelopment Fund will be, I think, a 1.4. El Luchador was, I think, around 1.4 equity multiple. So fairly standard with the last few developments.
Yeah, with ones that don't take a long time. Normally, people that are looking to invest on a 5-year, it may be 2.5 times cash. But here, these are 18 months, maybe 2 years, and so the equity multiples are smaller, but you're getting your money back a lot quicker.
Yeah, so a little bit more on the demographics. 5 Mile population, 102,000 people, 35,000 households, average household income of $96,000 with a median of
That's pretty strong.
Those are all
80,000.
good numbers.
And the Southwest Wilshire Boulevard, which is where the site sits on, has 39,000 cars a day.
No, that's good too.
Yeah.
So great little location there. We think it's going to be a great deal. It is a $2.161 million equity raise.
That's pretty big.
We'll end up being, 10, 20% of that ourselves personally. We're raising the rest. So today's Thursday. This episode releases on Monday. The investment will probably release Friday. So a couple days before you saw this. So it might still be open.
Yeah. If we sent out $5.7 million last year, raising $2 million might not take too long.
The last one we did was $1 million equity raise and it sold out in an hour. So this one could go
2
fast.
hours. 2 hours.
2 hours. It's $1 million an hour. Is that how it goes?
That's how it goes.
No way. So anyway, that's the first deal of 2023. I think we can expect more of these. There's several, I think, in the pipeline that can come in maybe the end of the first quarter. We have not a whole lot else in the pipeline right now. I mean, the shopping centers, like I said, it's a great shopping center with a great owner is not really going to transact right now. I mean, not that I'm seeing. The shopping centers that are trading are really distressed, bank owned people.
Or unrealistic cap rates. I am seeing cap rates inch up.
Slowly.
Slowly. I'm starting to see some 8 cap deals come back in the market, 8.5 cap. They're not primo spots, but I think we're going to see more of that. And I think the inflation, the numbers came out today. They were a little lower than last year increase. So I think this thing may start to stabilize, and hopefully rates can start coming down in the next 6 months to a year.
Yeah, that'd be nice. These developments, though, are popular with our investors. A lot of them that I've been surprised is that they like giving us their money and they like getting it back in 18 months with a nice little profit, right? As opposed to putting it in one of our shopping centers where, we might not sell it for 5 to 10 years. They like getting their money back and then they've got it to do whatever they need to do with it, reinvest it or buy something if they want to. But these development things have become really popular with our investors.
Yeah, there's several I've talked to that, it turns into a job because the money turns so fast. You end up, paying a little bit more taxes immediately, whereas a long-term investment, that's kind of deferred until you sell or maybe it's deferred until you trade into something else and that sells. And then, just if you're doing a lot of these, constantly having to find the next deal, like Joel was talking about earlier, it's hard to find these deals. I mean, if we just had a dozen of these in our back pocket, it's not like we're just strategically releasing one a month over the next year.
It takes more work. I would say, and investors can take my word on this, I like the cash flow. I like steady cash flow.
I actually do too.
So every month I know that my investment shed, whatever they shed, 100 grand or whatever, and the finding of the deal is hard. It takes work to close the deal. Then you have the sale takes work to organize. And then you have the taxable event. Now, of course, if we hit our numbers and people are getting a 1.3 equity multiple after 15, 18 months, and they put in another one and they compound that and they compound that, yeah, it pays off. Yeah. But we'll keep trying to deliver both options. We want to deliver cash flow opportunities, and we want to deliver cool, brand new development opportunities.
Well, I think I'm excited about the deal. Go on the website, see if there's still room left, see if it's still open. We are excited about this year. We're going to have a ton of deals. We had an amazing year last year.
Hopefully this one's better.
Yep. You probably have already gotten a ton of investor updates. You probably have a ton more on the way. And you're going to get your K1. I promise. I promise you're going to get your K1 as fast as possible.
When are taxes due? The 15th?
Yeah. Can we just all agree
by the
to file an
by the
extension?
13th, you're going to get it.
Yeah.
Like, just let's be real. File an extension. Just file an extension. Just do that for me. If you like me, be like, you want to hook up Braden? File an extension and say, Braden, I got you. I filed my extension. Don't worry about my K1. then you're my best buddy.
Yeah. Otherwise, we're going to get like hundreds of calls. Like, where is it?
We will.
Probably starting next week.
I can list the guy who's going to ask first.
Yeah.
I can him who will not be named.
Yeah, him who will not be named.
All right,
Anyway, we'll
guys,
catch you
thanks.
next time.
All right, bye.
On how to invest in commercial real estate.